Stock started the week off a little weak here at the beginning of the day, but rallied throughout the day before pulling back at the end. I'm going to break down what's driving today's action, how it affects our expectations of this bullish intermediate posture we have going on, and whether or not we've had enough of a pullback now to put a little ice on those expectations. So we'll break down the technicals from that perspective. We'll take a look at what was driving today's price action and what it means for our market posture. We'll also take a look at a trade idea on a stock that appears to be breaking out like many others, but in this case in a sector that we haven't paid a whole lot of attention to recently. So let's go ahead and get started. Today is Monday, September the 23rd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's go ahead and start off taking a look at the market forecast with the S&P 500. Now, if you notice, a lot of these charts here are updated here as of 9/20. Brandon issued a big release over the weekend. As you can see, I've got three whole lists of updated charts, including our market forecast charts with custom scripts here that are available for premium Market Scholar subscribers. So if you are one of those, make sure you should receive multiple emails. Make sure you update your charts there. And again, for those who are checking this out on the trial, on the 30-day trial, the scripts are available for the yearly premium subscribers. And keep in mind that while the monthly plus subscription is $99 a month, the yearly premium works out to being about just a little over $80 a month. So keep that in mind when you're checking this out there. All right, let's take a look at the S&P 500 and see. We can see we finished flat on the day, down 1/100th of a point, down about a quarter of a point. So really, really flat, even though we had about a 17-point range today. So that kind of gives you an idea that we weren't completely flat, even if we closed flat. We were off of the lows, well off of the lows early in the morning, but we were also off of the highs at the end of the day. So a little bit of trading. We're continuing to trade in the bottom of this daily shadow here on the S&P 500 from a few days ago. You can see we're still holding up above this 23% retracement level, which is where that long lower shadow pretty much touched on the low end of the day. It brought the near-term line down. Again, it's down below 20. It's not into oversold territory. We still have a strong bullish posture. See that? We still easily have a strong bullish posture here. Market sentiment's not quite rising yet. It's getting closer, but it's not quite rising yet. It's still above 50. And short-term sentiment, while it has pulled down, didn't drop into the reversal zone. So, we're not, this isn't, it's a little bit of a red flag that the near-term line didn't get above 80 and stay there for a while. And it's only stayed above 50 for a few days. A little bit of a red flag there. So we want to confirm that with a drop on the near-term line into the reversal zone, and for the near-term line to stay below 50 for longer than the 1 to 3 day average. So that either means we're going to bounce up here tomorrow or Wednesday at the latest. So tomorrow would be the third day. So either going to bounce up tomorrow or Wednesday at the latest, or if this drops into the reversal zone, then there's a good chance that we can at least get the intermediate line dropping below 80 and forming a weak bearish posture, light pink shading on the chart. As we talked about before, if we were to fall down to 2950, which is definitely within the realm of possibility, then there's some support down there, and that would most likely coincide with at least a weak bearish posture. It wouldn't be trend changing, but it would be enough of a pullback to produce that weak posture there. As always, the Russell 2000 has been pulling back too. Its near-term line and momentum line are pretty much sitting. Neither one of them got to extreme lows, so we are just in the midst of a pullback. Its intermediate line is closest out of all of them to dropping below 80, but you can see well above the intermediate, the moving average. So any pink shading we get would be light pink, and most likely just be light pink shading, kind of like this, before we turn back up again. So we're still in the midst of a near-term pullback. We bounced today, but off of the lows. The lows were lower. So we ended up flat on the day and down a little bit on the Russell. But the reality is, we should bounce into the middle of this week. if not into towards the end of next week. All right, before we look at some other charts here, a reminder, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of our screen, then hit the red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, that you got something out of our video today. You liked our video. And number two, that you want us to do it again tomorrow. So it's a quick way to give us feedback. It's our only survey that we send out there, so just let us know down below. Also, comment down there. What did you get out of the video today? What do you think people, when people come watching for the first time, as so many do, why should they watch it? What will they get out of it? Let them know in the comment section down below. Join our daily market outlook email list. There's a link up there popping out in the top right corner of your screen. Click up on that link to subscribe to our list. Follow me on Twitter for more content in between these videos from day to day, and join our market outlook community that we've created on Facebook. Also a reminder that we do post our market outlook trade ideas before the market closes, just as we did today. That's our market outlook live, where we also go back and review previous market outlook trade ideas from prior videos. So check that out there. There's the link that takes you to that product, that video, as well as all the archives are posted there too. That is available for our monthly subscribers. So here's a link here that will give you more information on that, as well as a free trial version, a 30-day trial version to check us out, including those two classes. Also, while you're down here, we invite you to engage with us on social media. The more you engage with us there, the more likely Twitter and Facebook will push our content to the top of your timeline. Otherwise, you might not see our content at all as we post it throughout the day, based on the algorithms that they have. So just to make sure that you get it, it's best that you engage with us. We try to make it really easy. Click on this heart. It opens up this window. You can like our tweet there. Click on this image. It takes you to your Facebook page, where you can like today's Market Outlook Facebook post as well. Facebook's even worse than Twitter is, but either way, a simple like will make sure that you get all of our content always on your timelines. All right, if you take a look at the long-term chart, you can see we are really, really in danger of a transition candle here. And typically, you get 4 to 13 of these bullish candles. This week's Heikin-Yashi Open is at 29.7690. We're about 15 points above that. So, and considering the range was about 17 points today, that's within a day's range of getting a little bit of a lower shadow. Of course, the transition candles tend to be relatively big. They tend to be smaller on the upside than they are on the downside. You can see after the pullbacks, the transition candles are bigger than the ones on the upside. They tend to be smaller. So just keep an eye on that. When you get the small bodies after bigger bodies on this candle, that's a suggestion that we might be slowing down. The momentum is slowing down this week as the gap, it's still rising, but it's slowing down. So we'll keep our eyes on that in terms of the long-term view to see if this turns out to be, this is only week 4, so we would expect there to be more bullish candles going forward, just maybe not to the same size as we've seen. But of course, anything can happen. So we'll keep our eyes on that. If you look at the 3 green arrow chart for the S&P 500, we obviously have the MACD histogram down here towards 0, giving us a red arrow. We don't know yet if it's going to be like a complete reversal. So we'll keep our eyes. The buyers are still in control according to the stochastic indicator. If you look at the 2-line version of this, you can see we're basically flirting, or we did at the open today, flirt with the 17-day moving average, which again, if this histogram is just going to be a brief little dip and one little red arrow before we turn positive again, not that we're going to get a big surge, but that we at least turn positive like we saw here. I mean, that was a pretty decent move coming off of a pullback on the S&P 500, and the histogram never did really get big because we were already so high. So we have pulled back a little bit below the moving average. We have flirted with the 17-day. Now the expectation is we'll get back above the 8-day and make another run. Make another run up above while the MACD remains high and the average stays high, and the buyers, as you can see here, stay in control. Now let's take a look at the intraday chart for SPY, and you can see how we have pulled back down yesterday. Here's where we opened today. We opened at the lows yesterday. You see how we're building up a volume node here. The point of control is above us, and we had a little bit of a pullback here, but we're building up a volume node. A break below these lows, and then, I mean, we're down. We're dropping down to at least 292.5. I mean, there's very, very little volume, simply because we have a gap here that, you know, could be viewed as somewhat as a breakaway gap. A little bit of a bump in volume, not as big as one as we like to see, but a little bit of a bump of volume there. But if we break up above this 299 level, then you can see we have volume gap to the upside till we get to 300, and we're back to flirting with that area again. So, you know, those are the key levels to watch here, especially considering how small the range was today. If I go back to the 3 green arrow chart for SPY here, you can see that we had about half of the average range, and the volume really dropped off down to 47 million and a half shares. So if I were to kind of put those numbers into context, here we go. 47 million shares is way below the low end of the 52-week range for the average. And, of course, 1 3/4 points is also way down here at the bottom end. So considering that these are our down days and they are actually below the averages, that kind of shows you just how bearish they are. They're actually pretty bullish. These are pretty bullish. This is a pretty bullish pullback, as you would expect it, down to the 8 or 17-day moving average. And now, again, the expectation is support would hold until it doesn't. That's the expectation, and we'll see if that ends up being the case. Again, no, if we don't hold, then we're moving down here pretty quickly, down to 292.5, based on that volume profile here on this chart. Nope, not this chart. Sorry, I'm still getting used to the new orders for these, but based on this chart, getting down to 292.5, you can see we'd be filling in that volume gap pretty quickly. Let's take a look at the volatility chart right here. And you can see, you know, we are right back up to this midpoint of the bullish area. So we had pulled down. We had a little bit of a jump up today. We're above 15, which, again, typically 15 kind of coincides with this 90% level. And so the fact that we are right back up to 15, but we're not back up to 90%, kind of shows us that this volatility might be a little artificially high. You know, there's expectation that we'd expect it to come down. We'll see if that ends up playing out over the rest of this particular week. All right, so before we look at some other charts, just to summarize what we've talked about so far, is that basically we're on a bullish trend. It's a new bullish trend, so it's not like there are some things that aren't quite set in stone yet, like the market sentiment's not rising, and there's a few other things. But the reality is there are a lot of things that are set in stone. Volatility is low. It's not as low as it could be, and so there's a couple like little bit of red flags there. And we'll see if those red flags turn into something more, or more likely, as expected, will turn out to be nothing. And as the market continues to bounce off of what appears to be a pretty bullish pullback, as bullish of a pullback as you can get in terms of ranges and volumes and, you know, retracement levels and things like that. And then we start heading back up on this new trend that we've developed. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out where you can vote. Hit either agree or click the link first, then vote either agree or disagree. If you click disagree, a comment down below on what you're seeing that would suggest otherwise, right? That either maybe you are a lot more bearish than what we're coming out with, which is perfectly fine. A lot of people are. But what are you seeing? What charts suggest that we should be a lot more bearish? And we definitely invite you to share those with our Market Scholars community down below. All right, now let's talk about what's driving the price action. As you can see over here on the left, it's kind of an interesting risk-off kind of a day. At the bottom, volatility was down the most, so that's a little different than what you'd expect. But you can see emerging market bonds, developed market stocks are down here at the bottom, which are kind of an odd pairing. At the top of the chart, you see golds up here with agricultural commodities, dividend stocks, the more developed market bonds, commodities, as well as mid-cap stocks up here, and outpacing what we see from large-cap stocks as well as small-cap stocks. So they kind of had a little differentiated returns. You can see emerging markets also held up pretty well today. If you look at just today alone, Treasuries and gold started the day up, and they finished, except for yield bonds. Bonds fell and gave up their gains. They didn't really have big losses, but they gave up their gains by the end of the day. You can see one big reason for risk off was crude oil. Crude oil started the day down, so stocks started the day down. But as crude oil rallied throughout the day, you can see stocks rally too. A little bit of a late selling, but crude oil rally and crude oil kind of reflected this growing risk appetite. At one point in time, small caps were the biggest winners on the day here before a little pullback here into the end of the session. This is what it looks like in the last week, the last 5 days. You can see again here, this is the pullback off these highs, and bonds and gold are your bigger winners. Again, it's kind of this pattern of they were the big winners. They've sold off the most as stocks have bounced. And now with a little bit of a pullback in stocks, they're bounced, right? They've sold off the most as stocks bounce. Now they're bouncing. But it's just, we'd expect it to be brief simply because, again, simply of a short-term risk appetite. You can see in the last 5 days, crude oil is down about 5%. If you look at its chart, you can see what it looks like here. Let's go to its market forecast chart. You can see the pullback, again, the big rally in terms of Saudi Arabia, and then coming off of that, we're down. We're still down, but we're trading at the lows, which was the old high point here, and we have a weak bearish posture on crude oil. In fact, if you take a look at all of them here, let's see, it's this one right here, the 12 grid. Nope, it's not the one I wanted. It's 12 grid right there. You can see, how stocks across the board have strong bullish postures. Dark green, high yield bonds, real estate stocks, all green, preferred stocks, all green across the board. And you can see bonds and gold are light green, right? They have weak bullish postures. They're both below 50, but rising with green lines. TLT is still below its moving average, and there's foreign bonds kind of looking weakly bearish as well. On the other end of the spectrum, you have weak bearishness in yields in the 10-year yield. Remember, TLT is long-term is 20 to 30-year bonds. TNX is the 10-year yield, and then crude oil. If I were to take a look just here at TNX, we basically have pulled back. In fact, I would expect we might get a little bit of a bounce back up, but I would expect for the most part it'll be hard for this to get too bullish until the Fed's had its last cut. And right now, the market's got a coin flip for a rate cut. In fact, it's a little bit better than 50% odds for another cut here in October. More than likely, the next cut will be in December, where we have a 70% chance now of a rate cut. But then, it's getting more and more likely that the Fed may be done there. As you can see, the odds of a no cut by next April at all is 86%. So we don't have a full one more rate cut completely baked in. Well, we do for the most part. We only have the one, because after that, this is what 50% added together. So we basically have a 50-50 shot by next April that we'll get a second cut. So the market is pretty much saying we'll get one more probably by December. You can probably take some time off here in October. Let's see what the data looks like. And the data has progressive. You can see the economic surprise index continuing up to 44.7. Very, very bullish for the markets here for these indicators to get to. And remember, this is also a rolling 3-month window. So it's not just the indicators we're getting like today or yesterday or Friday. It's more and more, it's this rolling window. So the 3 months ago, the indicators are rolling off the window, could very well have been pretty bearish, and now they're rolling off. And so it's a 3-month rolling window of indicators, especially the ones that have the most relevancy to the volatility and the underlying currency, in this case, the U.S. dollar. The worst news today actually came out of Europe. Germany's trade or PMI numbers didn't look so good. So things actually look recessionary over there in Europe. Here in the U.S., on the flip side, the Chicago National Manufacturing Index actually rolled up to 0.10. That's a pretty decent sign that it's getting positive again. This is the conglomeration of all the PMIs, regional PMIs, and manufacturing surveys. Remember, these are surveys, so these are soft data points that are here in for the U.S. You can see here, really things peaked, and a lot of these indicators on a year-over-year basis peaked in August of last year. We've been rolling over and been pretty bearish here. Well, this is since August of 2018 is when we really rolled over. But now you can see, really pretty much since April, a lot of these are starting to roll up and come back up to the upside. So, what was one of the worst readings that we've seen during the expansion here in April, now we're back. We're just like that, back to being positive, coming off a much higher low point here. So it does fluctuate, it goes up and down, as you can tell, but you can see there's a good this is a good sign that we've gotten right back up to being positive after coming up off of a much higher low point. So what that means is, again, if we get, according to what we saw in previous quote unquote mid-cycle adjustments that the market that the Fed refers to back in the mid 90s to late 90s, we did get a few rate cuts. We got 3 of them each time. This one more cut would be our third one on this go around. The yield stayed down until we got that last cut, and then after the last cut, the yields took off to the upside. And also too in the late 90s, when we had that last mid-cycle adjustment, the yields in the U.S. were so much higher than they were in Germany, and that's the case right now too. So again, that would mean if we are rising, that yields over in Europe would be rising faster. So until we really get that scenario playing out, we're more than likely going to continue to have rate cut odds stay high. As you see, if I were to go to the 10-year minus the Fed funds rate here, and let's go to a 1-year chart. And then go all the way in. You can see this is as of Friday. We're down. Now we're only down 0.15. That's well off because of the rate cut here on the 10-year. We are now really darn close. So one more rate cut would get us back up above positive. And again, for some perspective, back in the late 90s, to look at it again. And let's zoom in. And that's fine. The mid to late 90s. So here's the mid 90s where we dropped all the way down. By the end of 95, we dropped below zero. We started to get our cuts into, actually it was like July of 95 when we got our first cut. And then by the end of the year, we got 2 more in December and January. And then you can see it took off, right? And then we had again another period in 98 where we flirted with zero again. And we got another mid-cycle adjustment in 98. As you can see, here's the zero level. See all the time that we spent there. And after that was over, we rallied going into 99 and by the time we peaked. So again, you can see we're not out of the woods yet. We're still below zero. In fact, we're a lot further below zero than we were in those mid-90s areas. But one more cut more than likely would be enough to get us above zero and get us going again. Again, that would also most likely coincide with yields in Europe starting to ramp up even more to close off that spread, that really, really wide spread that we see between U.S. and German 10-year yields. If you take a look at the dollar index, it was back up again today. It's really holding that $98 breakout and continuing to trend higher. We alternate between dark green and light pink shading, but the trend remains bullish. The green line continues to move higher, and we're above it. So we're back to pretty darn close to back to being dark green shading again, and the short-term sentiment lines trying to cross up above the green line and pull them back up again. And we'll see if that ends up being the case. Of course, the more likely the dollar is to go up, then the more likely you'll see a lot of these international stocks still kind of weighed down a little bit. There's a lot of dark green shading here on this chart now that they're all, we can see how bullish we are, and there's only a couple that are showing light. They're both above 50, but they're showing light bearish. You also see green lines all across the board. We're above rising moving averages. Some pulling back more than others. You can see the big pullback in Germany and France today. They had kind of bigger pullbacks. UK a little bit. Japan's a little bit of a pullback. Along with China, but you also see some of these really starting to break out. Like India is starting to break out. Japan had been breaking out. Korea is looking much better and well above its moving averages. So these are all really good signs because they've been the biggest losers. All of these, they've been much bigger losers than what the S&P has been over a long period of time. And so for them to really kind of gain some ground, even in the face of a strengthening dollar, is a very good sign for the markets. Or for risk appetite, I should say. All right, if we take a look at the sector moves, let's take a look at the sector charts. So it would be right here. So let's look at this one first. Again, you can see a lot of dark green, which means we have strong bullish postures, even if some of them say falling, because we are above the moving average, similar to, or above the 80th percentile, similar to what you see on the S&P 500 as a whole. There's a few light pink shadings, and again, simply just light pink. We don't have any dark pink shadings out of any of these sectors. So at the worst case scenario, we have some weak bearish trends that are going on in some of these more some of these interest rate sensitive and safe haven areas and consumer stocks too. And these are the stocks that actually led the way higher today with these consumer stocks. If I look at the sectors, your staples and discretionary, along with real estate, but the staples and discretionary and then technology are all your biggest winners. Healthcare, a little bit of a pullback today. FANG stocks getting caught in a pullback as well. And then there's your materials and industrials, more dollar sensitive areas that struggled with some strength in the dollar. All right, so for our trade idea of the day, I do want to take a look actually in the energy sector. A stock that appears to be breaking out a little bit is Phillips 66. You can see it's on a bullish pattern. It's got a bullish market. The market sentiment is relatively high. It's still falling, but it's relatively high. You can see we're trying to break out above this previous intermediate high point we've had after this short pullback. You can see if I were to take a look at its Bollinger Band charts here, we're also trying to break out of this value area of its volume over the past year. Very little volume up above us because we dropped down over here so far so fast. And then again, this is a rolling window too, so as this rolls off, we have even less volume up here in these areas and more volume down below us. Support eclipsing some support right now right around this 102.5 level, and then this biggest level of support just below 100 where its point of control is. So a lot of support below us, very little headwinds up above where we're at right now. If I take a look at its 3 green arrow chart, let's go over here to its 3 green arrows. You can see it's been flirting with its 17-day moving average last week, only on an opening basis, closing above and bouncing off the 8-day moving average today. It's MACD histogram doing what we expect the broader markets to do, where we had a little bit of a surge, we pulled back towards zero, and now we expect it to, for the actual value itself to remain relatively high, with the average just getting up here and the stochastics being relatively high as well, as we maintain a position above the rising 8-day moving average. If I take a look at its DMI, you can see that we are crossing up above 25. At least the positive directional index is above 25. The negative directional index is easily below 20. In fact, it's been well below 20. So again, kind of shows us how bullish we are. It'd be more bullish if we can get this above 30 and we get a good trend going. That would also show up in its trend strength indicators. If I look at Ichimoku cloud here and its trend strength indicators, you can see we have a moderate strong trend, almost a moderate trend. It's got to get above 2.5, or no, we are above 2 and above 65. Of course, to be a strong trend, we need to get above 5 and above 80 over here in this area. So we're working our way up towards that end because we are above the cloud and we are above its Tenkan line here, the green line. So good bullish trending patterns all across the board, with that Bollinger Band getting above the value area on the volume profile, then we have an opportunity for a pretty decent directional trade heading into November. Now, there is, before November expiration, there is earnings coming up, so we do account for that with a smaller position size than normal, and that might be add some fuel to the fire if we were to get up above and stay up above this 110 level. But we'll sell that 110 by the 105 it sets us up for this trade where we have about a little bit better than a 1-to-1 reward risk ratio on a maximum basis. Of course, if we keep the max loss to half of that, now we end up with about a 3-to-1 reward to risk ratio. If we cut our max loss in half and go for the max gain above 110. So a good opportunity here, very easy. And again, to get down into this area, to get to where we lose half, we'd have to get down below this support level, and we'll start working our way to the downside. So we have a lot of support below us to help avoid this area and have a good opportunity to work our way now up to the upside here. Let's reset that. There we go. So again, to get to 420, we'd have to get all the way down below $99, and just to kind of show, at least today, and to kind of show you where that $99 would be for PSX. We'd have to get basically down towards that point of control and break through all this support into the lower half of the bandwidth, and away we go. And away we go to the downside. So it's possible. It's harder than it is to go up, but it's possible, and so we'll manage our risk accordingly if that occurs. And if it occurs with this risk over here on 1025, this earnings announcement, that's why I actually have the date over here on 1025. Then you can see on its earnings, that 420 loss comes up now into this 102 area. So we'd have to kind of hold this point at this volume node here. So if we're tracking below that volume node, by the time earnings comes out, then we can pretty much take our loss on that trade and move on to something else. Of course, we'll be talking about that in our Market Outlook Live videos. We'll manage the trade accordingly, and you'll be able to see how I look at things from day to day on this particular trade. All right, well, that does it for today. Now you've heard from me, I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. Open up any new thread with any questions or comments you have about tonight's video, or for that matter, questions or comments you have about anything that pertains to this topic, as well as reply to anybody else's threads that you see. And let's keep this conversation going here in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that that thumbs up icon down below, and comment on the video. Also, follow me on Twitter for more content in between the videos, and join our community at marketscholars.com. As well as the Market Outlook community that we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.